Professor Jeremy Siegel of the Wharton School. Professor, your reaction to this print on the CPI and the subsequent move in stocks?
Well, Scott, this is what we've been talking about, I think, for the last 3 months, that inflation is much lower than the Fed thinks. In fact, let me give you an interesting statistic, and follows up on what Josh was saying and what I have been saying for months, actually more than a year. If you put the actual home and rental price index in, not the one the Fed uses, which is very lagged, the actual one in today's index, you get negative core inflation. Negative core inflation. I mean, take a look at what core inflation on the shelter part was. Plus 0.8%. I mean, that's ridiculous. It's nowhere near that.
No way.
No way. I mean, that's the only, by the way, that's the only reason why core was positive. Not only is it zero, it's actually negative. And so if you put a negative number in, we're in negative inflation mode if the Fed uses the right statistics, not the faulty statistics that they've been using. So, you know, I mean, you're saying when should they pivot? Yesterday. I mean, yeah, they'll probably go now 50 and stop. They don't really need to even do that because everything is in the down mode. You know, I told you last June, I thought the danger was the Fed was getting too tight.
Right.
And now, you know, I think the data is showing, yeah, maybe that's true.
So if you had your way, what would they do next month in the December meeting?
Well, there's a lot of data coming through. I'm going to have another month of data to come through. But if the trends continue, I would stick with where we are. Now, I don't think they will. I think they're going to go to 50 and announce a pause. And that's what happened today. I mean, you know, the data today sort of confirmed that negative. If the data continues to go the way it's going, see no reason why it isn't. What's going to be to go 50 and announce a real pause.
Hey, what happens?
And that's why we have a 1,000-point rally today.
By the way, we get a CPI print the day before the Fed meeting in December. If that continues the trend of what we see today, does that potentially influence a 25 instead of a 50?
It could be. I mean, it could be in terms of, and what other real data comes in. We had a slight uptick in jobless claims. If that starts going up, if we see weakness in the November employment report that we're not expecting, that combined with another good CPI, that might put pressure on them even going less in their December meeting. But don't forget, the housing component in December will still be plus 0.7, plus 0.8, which is 40% of that index, and it'll continue to push up as the housing market goes down, and that's the nature of the statistics that they're using.
Professor, so what does this mean for stocks? Obviously, you know, massive move today, relief in many respects, but what happens from here? Do we have the opportunity now for a significant end-of-year rally at minimum? Yeah,
I think we do, because I think more people that think about the fact that that inflation is basically over, and something I said 2 months ago, inflation is basically over, and the Fed doesn't have to get anywhere near as high. I mean, I was shocked at Powell's last news conference. Oh, we're going to be. I feel we have to be more hawkish than we were last September when all the data was pointing down. He's going to change his tune, I think, when they get to the real world data in their December meeting. But I think this does make for a good year-end rally. I'm not necessarily true. And the question you asked Josh about, does this reignite tech? I mean, I think the NASDAQ's still selling for 23, 24 times next year's earnings.